Okay, now let's look at exercise 10-11. So the company purchased some snowplow equipment on March 10th, had a cost of $150,000. We're ignoring taxes. Show the journal entries that would record this purchase and payment under the three separate situations. So in the first case, we're saying the company paid cash for the full price. So therefore, we just record a debit to equipment, which increases our equipment account, and we credit cash, which decreases our cash account. Part B, the company purchased the equipment on credit with terms 130, net 60. Payment was made on April 9th. So originally we record the purchase, almost the same as what we did in Part A. We debit equipment, but instead of crediting cash, we didn't pay cash, we're going to pay it later, so we credit accounts payable. So effectively here, we're increasing our equipment account and we are increasing our accounts payable account. When you're doing the journal entries, then make sure that you do the little note on the bottom. So we're explaining that we purchased equipment on credit and we include the terms. So what we're saying here, if we pay it within 30 days, we get a 1% discount. If not, the full amount is due in 60. So they say that they paid April 9th. So it was March 10th it was purchased, so they do pay it within the 30 days, right at the end. So therefore they get a 1% discount. So to record that, we debit our accounts payable the full amount, because we are wiping clean the full accounts payable. We are paying the full thing. We're paying $148,500 in cash, and the rest, the $1,500 here, is the discount. So it's $150,000. 1% is the discount, so $1,500. And that discount then is a credit to equipment, because the equipment didn't cost us $150,000 after all. It cost us $148,500 because we took the discount. And then in Part C, the company signed a 12% one-year note for the full purchase price. The note was paid on March 10th, 2021, the maturity date. And it says we can ignore year-end accruals. So again, on the purchase date, we debit equipment, credit notes payable. So again, effectively here, we're increasing the equipment account and we're increasing our notes payable. So then we include a note that the equipment was purchased with a note. You could include, a 12% one-year note if you wanted. Then when the note is paid, we debit note payable, because we're getting rid of the $150,000 note. We're paying the amount of the note plus the interest. So we have to calculate the interest. So the interest is $150,000 times 12%. And if it was less than the full year, we would multiply it by the amount of the portion of the year that it was outstanding. But here it was for the one full year, so we just multiply it by 12%. And that gives us $18,000. So we record interest expense of $18,000, and then the note plus the interest are paid in cash. So we credit our cash account $168,000.